Good morning, everybody. Welcome to our the Angels Brief podcast series we're starting in 2025 with the intention to bring angel investing to the forefront in the community, and for people to learn everything they need to learn to know what involved in becoming an angel investor or participating in any of the angels community here in Michigan. Today, I have a special guest, Skip Sims from Michigan Angel Fund, a former Spark champion, if you will. And Skip, and many going to say he's the godfather of angel investing in the state of Michigan, strong advocate for it for many, many years. And I'm going to let you introduce yourself, Skip, say a couple things about yourself and your background. It'll be great.
Well, thank you, Doran, for having me. I get a little more credit than I certainly deserve. I did work for Spark for many, many years. I was a co-architect with the original Michigan Pre-Seed Capital Fund in 2006. Managed that for several years, and then in doing so, learned that the missing link in our entire tech ecosystem in the state was angel investing. The VC industry was pretty well established by then, had a lot of VCs in the state, had a lot of capital to invest, but they'd gone downstream and were investing in later stage companies that were a little more mature and no longer in taking the higher risk and investing in those really early stage companies. The state had their pre-seed funds, and they were providing, capital for that. But the missing link and the transition that needs to occur in our state is from the public sector, meaning state money, to the private sector, meaning angel investors and VCs and private equity, et cetera. So that's what I started out to do. That became my focus in 2011 with Spark support. And we created a different kind of model to create an angel group, which we were successful recruiting over 70 angels at that time in 2011, 2012, which was a record. I don't think any group was that large at that time. And we, made several investments, and we've moved forward and added more angel groups because that was part of our mission, if you will. We got some grant support to do that, to reach out and try and create additional angel groups around the state and get people interested. And so that's where we're at today.
Yeah, I got to Skip. And my former partner or retired partner or president emeritus of Birmingham Angel, David Weaver, which created the first angel group in the state of Michigan in 1999, actually.
Yeah, I was. In fact, I attended his first meeting in Birmingham.
Right. And since then, today, they estimating between 18 to 20 angel groups in the state of Michigan operating right now. But you need to say?
There aren't that many anymore.
No?
No, the pandemic influenced and affected so many things in our life. And angel investing was not immune. And we don't have nearly as many angel groups as we did in pre-pandemic in 2019. And we don't have quite as many angels involved in groups in total. But we do have active angel groups like yours that are still very much involved and screening opportunities and looking for opportunities.
Okay, I appreciate it. So, one of the things that is my experience in the Michigan ecosystem, and remember, I was born and raised in Tel Aviv in Israel. I grew up in a different startup nation dynamic. That there, despite that there is Birmingham Angels and Michigan, Ann Arbor Angels and Point Angels and Kalamazoo Angels and North Michigan Angels, whatever the groups are, but yet there is no collaboration between the group. I mean, here and there on a personal level, yes, but even the monthly angel call that we're having, it's very light in many ways, and the number of companies that everybody looking at is like fraction of what the Michigan ecosystem can offer. So we actually, kind of side note, this year decide to launch, which is going to be launched in 30 days or so. We created a portal called MichiganStart.com, which using our platform, SidePitch, we developed. We want to kind of create the centralized Michigan deal flow. If you're a startup company, you need to be on Michigan Start. So everybody can search and find it, right? But our experience since we starting the Angel Group here, that there is not too much collaboration between the group. Brenda was here earlier talking about that she have to get dragged from Angel Group to Angel Group to Angel Group to Angel Group, go to the same thing. And I keep saying, why? Why not centralize the whole thing? Why not doing one monthly pitch event to all the Angel Group for the same companies and put some momentum behind it? So there's a lot of work to be done. But our experience in Oakland County, Skip, is that many wealthy individuals sitting in the sideline are not participating because of a fear or risk adverse or any of that. They just don't participate because they don't know where to start. Some of them don't even know Birmingham Angel exists, although we're here in Birmingham. It's this kind of thing, right?
Yep, I agree. Getting a megaphone out there to tell the people about it, about angel investing as an asset class, it's constant work. And sometimes you can do it in small groups. Sometimes, it's hand-to-hand combat, if you will. It's meeting one-on-one in coffee shops, just like the entrepreneurs meet with angels and VCs one-on-one in coffee shops. It's no different. But I think part of the challenge is, and for example, if you're a member of a country club and you talk to your buddies about angel investment, they will say, yeah, one, maybe they don't know anything about it. Tell me a little bit more. Others will say, yeah, I've heard about it, but I'm just like classic Midwestern people. We're a little risk averse. Right. Our tolerance for risk is not real high. So you're looking for those people that are more ambitious. And oftentimes, and I think you alluded to this, there are people who have been successful with tech companies and have successfully sold those businesses, made a fair amount of money, and are willing to, step up and help the next generation of entrepreneurs. And quite a few angels invest on that premise. It's not so much for the return, which I always harp on. I said, look, if you're an angel investor, you need to go in expecting or wanting a return. But an awful lot of people are doing it because they just want to help the next generation. They just want to be in there and participate in some way for the good of the cause, to help the overall economy. They appreciate the fact that tech companies pay higher wages and grow faster, create wealth. And all of that translates and trickles down to the economy in general.
I know, because we said that angel investors create jobs, venture capitalists rearrange the capital, and private equity rearrange the assets. So we're basically saying another way to say angel create the job, private equity get rid of the jobs, right? kind of in many ways. But yes, without early stage capital, I mean, Professor Brophy and I talking about it for years that half the company created here in Michigan end up outside the state because they can't raise early stage capital. They go outside the state to get some investor put in, but the condition is stay here so they don't come back. Some of them start coming back, but it's kind of the heart of the thing. Now, true angels, this is in my book, and you tell me I'm off. True angels is take the risk. Most of the company we invested in, at least half of them are pre-revenue. Some of them just passed the proof of concept. You take the true risk with those companies. You don't require a lot of later stage type of performance like the VC, kind of thing. And every angel group have their own criteria of what is good and what's not. But at the end of the day is what the investor wants to do, right? So I see some deals that I'm not quite sure that you put money in, the investor go all in, and some deals that I say everybody go in and everybody look at me like this. It's like, one of the companies, by the way, you're familiar with Line Leap, right? The company?
Yes.
So myself and another investor actually put money in Line Leap because everybody else told me I'm crazy. This is two young, crazy guys. What are you What are you doing with them? And now
Yeah.
everybody scratched their head like, oh, we missed the boat at this one.
Yeah,
Kind of
they
thing.
do.
And I know the Michigan Angel Fund have a little bit more strict rules because a lot of it come from economic development money, which is different than gonna think. But let's go back to evaluation. So here's my challenge. Company come to you and say, I'm raising $1 million round on a $10 million valuation. And you ask the question, where do you come up with that? And they say, well, my advisor told me, or it's a crapshoot. I'm just like a shotgun approach. I'm going to put it out there to see what I can get. Or they saying, oh, look at the last 10 exits in our space, company that sold for 400, 500, 600. And I keep saying, what's got to do with you? So we decided this year to do this. We developed a concept that I call flex value. What do I mean? You said to me, I'm raising $1 million, $10 million valuation because I'm going to do $2 million in revenue in the next 24 months. And I'm saying, you know what? I'll give it to you. In 24 months, when I convert the SAFO, the convertible note, whatever the instrument, if you hit $2 million in revenue, $10 million valuation, not a problem. If you hit $1 million in revenue, I'm converting in $5 million valuation. But if you did $3 million in revenue, I'm going to convert in $12 million. So I'm taking the risk that I'll pay more down the road, but I'm de-risking myself in the process because if you did well, oh well. But if you don't, because what's going to happen, and we know that, if you did $1 million in revenue, you will have to go back and do a bridge round, right? Which means that you will raise more money in the same valuation. I'm going to get squeezed, and because you didn't perform. But I'm maintaining the same valuation, which just doesn't make sense. So today we require from company to do the note or the safe on a flex value formula. They don't agree, we say we're not going to write the checks because there's so many bridge round and extended seed, or the company come back if the board gave me approval to oversubscribe on the round, which means okay, I'm squeezing again. I mean, like, what the hell? So my question to you: how critical do you think it is to fight the valuation battle?
Well, I think your concept is intriguing, and I like it. Because how many companies have you invested in that hit their goal?
20% maybe.
Not many.
No.
Yeah. And your point is, I think that's the reason entrepreneurs are raising capital on safe notes and convertible debt, as opposed to equity rounds, which was our original thesis. 10 years ago, we would only do equity. And that we wanted to set that valuation early and make sure that, and we put in our criteria, which I think your formula kind of negates the necessity for maybe. We would anticipate, we'd have that conversation with the entrepreneur. How much more money do you think you're going to raise? How much more money do you think you're going to need? And almost all of them underestimate it.
Right.
Almost all of them underestimate, one, the amount, and second, how soon they're going to need it and how many rounds they're going to need to get there. And so we wanted to make sure that going in, we had enough equity that with each round, obviously, the previous investors, you get diluted more and more. That's why you always want an up round. Now we're getting into the weeds, but you want it because you're going to participate. The other thing we tell angels, and I'm sure you tell your angel group as well, look, the money you put in today isn't going to be the last money you're going to put into this company. Plan on at least one more round, if not two. And so preserve, budget what you want to put into this company over time.
Right.
Don't put it all in up front. And so valuation matters, but it's another thing that's happened, and I don't know if I can blame it on the pandemic, but the timing certainly aligns with the pandemic, and that is fewer and fewer companies are raising on equity. They're raising on notes, and to your point, you're putting in your note that here's where I'll convert, at these various levels as opposed to a discount, which I like the idea. It's unique, it's different, but it's the entrepreneur can't say no to you. I mean, if the entrepreneur truly believes, they're going to do
It's
$2
okay.
million next year, then okay, we'll give you your valuation.
Yeah, I
If
mean,
you,
it's not like a hard deck, but in the same time, like you said, how many of the company that actually we invested in overperform or hit the targets or hit the milestones?
yeah,
Not too many.
none.
Some of it from good reasons, some of it for not. I mean, it's okay,
Very
right?
true.
But but the idea is this: so listen, you know, I I know that you want to position the evaluation to go to Series A, that you have a starting point that you can go from there. I appreciate it, but if you don't perform, it doesn't matter because the VC is not going to buy to it. They're going to look at your
Right.
performance and they're going to say you're not ready. So you're going to come back to me and said, "But Dad, I need more money." And I'm saying,
Mhm.
okay, so you actually want me to give you more money and diluting myself in the process, which makes no sense to me. So
Yep.
we need to maintain our position, the original intent of investing in the business until you go to Series A, either by do the flex value, so which means I convert in a lower valuation, still maintaining my position, give you more money. But when you go to the Series A, I'm not that weakening in my position. Otherwise, why should
Mhm.
I write the check? I mean, it doesn't make any sense, right?
Mhm. Yeah. Yep. The
So,
only reason you would is you believe that the company can perform.
right,
And that's kind of how we're investing today. You're
right. I
right.
mean, in the spirit of Detroit, we always say that you're looking at you're looking at the driver, look at the car, look at the race, right? So, you're always betting on a driver. You can fix the car, find a race, but you can't fix the driver, right? So and you're right, when I said to angel investor that looking to start the journey and invest, I said, use the 70-30 rules. 70% of the money that you intend to invest, you invest now, keep 30% to the future round, either the pro rata or even if you want to put more money because the company's doing well. But every dollar that you allocate to investing, 70% should go for initial investors, 30% dry powder for the next round. Can it do it? Do you think, at least from what you see so far, is Michigan company in general come with lower valuation that you see in other ecosystems, or they just try to mimic what they see in other ecosystems?
I think they're largely trying to mimic. They all have connections with people who have connections on the West Coast. So they say, well, here's what they're getting in California. And I said, fine, that's a different planet. Uh, that, let's get real. And what are you going to get in Chicago? What are you going to get in Columbus? What are you going to get, elsewhere around the country, even Texas? Valuations in Texas can be high, but at the same time, they're more reasonable. And so, they need to be realistic. So I'm not seeing valuations. They've come down a little bit, but here's the box that a lot of entrepreneurs have put themselves in the past 3 years, 3 or 4 years, and that is they raised the money on notes because they weren't willing to sell to investors on a percent of equity. And because they didn't think they would get the valuation that they deserved. Well, now, to your point, they've got all this debt on their balance sheet that, except for safe notes, is accruing interest, has a big discount on conversion. They need more money. And the investors are saying, well, with all that debt, we need that to convert. That means you've got to raise an equity round. You're going to have to absorb all that accrued interest and that discount. And by the way, who gets really crammed down?
The founder.
The entrepreneur, the founder. And they don't understand that going in, but they're paying for it now as they're having to do equity to get that debt off their balance sheets.
Right. I mean, there is few entrepreneurs that or startup founders that knock on the door that we sit down with them and I look them straight and say, you should not raise capital at this point.
Right.
You should keep bootstrapping it until you get to a certain point. I mean, if you start right now, you're giving up the farm. So you work hard, sweat, whatever you need to do, but don't raise capital yet.
Right.
Especially the one that say, "Oh, I just need $250,000." It's almost like being lazy. I'm going to try to use the investor money to do it instead of me sweating into it. So that's, but it's the concept of, let's not argue an evaluation, but if you want sell me on the performance of what your performance is supposed to look like in the most conservative way possible, as you tell me, great. Are you willing to bet on it? If you don't agree to my flex value, which means you're not betting on yourself.
Mm-hmm.
Because if you are betting on yourself, then you're not going to lose, right?
Right.
Kind of thing. So it's kind of funny when they say to you in the pitch, there's no way we're not going to fill the blank. And then you say, great, giving what you just said, it's a sign here. Well, I don't understand. It's like, it's a done deal or not?
Yeah. I give you a different example of the same thing, and that is a board member who the board was reviewing the budget for the next year, and the CEO laid out a budget and projected X number of millions of dollars of revenue that year. And the board members said, were asked, put $100 on the table. I'll put $100 on the table. I'll put my 100 will be that you won't hit that number. Your 100 is that you will hit that number. And the founder said, no, I'm not quite willing to do that. And he said, well, then what's the number you're willing to leave that $100 on the table for? And suddenly the projected revenue for the next year came down a little bit, more than a little bit.
Right.
So, the entrepreneurs, that's the other thing. And you need to also include this. When an entrepreneur is taking money from you and me, I look at it as that entrepreneur now has a boss that he or she didn't have before. They've got to report to us. That's in our deals. You've got to provide me a quarterly report. I want updated on how you're doing and your progress on a quarterly basis. Suddenly you've got someone else to report to. And I don't think a lot of entrepreneurs understand or appreciate that until, their feet are being held to the fire, so to speak.
No, I'm with you 100%. I'm actually, one of the conversations that I'm having with a lot of entrepreneurs, I went to the New Lab event a couple of weeks ago, I can't remember, and one of the portfolio company founder was there. And this is by chance a company that we actually did, we convert to equity. So we actually equity holder in the company. And he introduced me to some people around him and it says, here's the Ron York, he's one of our investors. And then when everybody walk away, I pull him aside, almost kind of took him in the thing. And I said, I'm not your investor, I'm your partner. If you forgot, I'm an equity holder in the company. So stop treat me as the investor, like the somebody sitting on the bleachers over there. My name is on the company right now. So yes.
There you go.
The reporting, and I mean, some of them come with this crazy thing in a term sheet that if you don't own at least 10% of the company, you don't entitled to get the financials by the end of the year. Like, what do you mean? It's like, I actually find very interestingly pay attention to everything in the term sheets, although it's not a legal document, for them to sign the term sheets before we sign the note, and then we actually started this year to do something called the onboarding call with the founders, with Leslie, our portfolio manager. She get them on the call and the 10 amendments that she needs to go with them. If they don't agree to them, they don't get the check. It's like really kind of thing. But no, I bring it to the foreground because I start realizing that the valuation can be tricky, especially from the pandemic till today. I mean, I looked at all the companies that came around the door in the last 6 months. 35% of them were raising a bridge round. And I'm saying, okay, something is off here. And then you start investigating that. What is a bridge round? Either underperforming or overperforming. It's either one. And most of them are underperforming. So if I'm your initial investor, it's a bad news for me, right? So it's so I'm saying it's worth fighting for this valuation. At least get the fairness point that, listen, if you can perform, then it's yours. But if you can't, you can't expect me to be the one that taking the punch on your lack of ability to perform.
Yep. And I think to your point, VCs do that. And, angels ought to be doing more of it.
Okay. It's great. I will shoot you an email with the model we put together, just see if you have any holes in it. But
Good. I'll poke holes in it if I see any.
Yeah.
You know me well enough.
Yeah, I know. I appreciate it. No, it's good. And this, kind of promo, we work with Oakland County. I mean, that Oakland County is one of the richest county in the state, and I'm sitting here in
In the
Birmingham.
country.
It's a lot of money. And we talked to Oakland County, and they willing to support us financially and otherwise to do an Oakland County early stage summit this year, and bringing all the wealth from Oakland County to, let's talk about angel investing and why Oakland County is the least county to participate, in early stage, and there's money there. So a lot of we'll bring founders, we'll bring stakeholder in the angel ecosystem, we'll bring some governmental support to really talk about everything and anything about angel investing that it's worth to somebody to listen to understand that there's a method to the madness, and it's not all risk, write the check and hope for the best. I keep saying people, there's methodology to it. It's not just, and it's actually less risky than people think it is. Right?
Well, I'm still a proponent, as you know, and it's good for the country, not just our state, good for the economy, and as you well stated, angels create jobs. It's our angel investments that create the jobs that the entrepreneur needs to grow that business, and we're providing the capital to do that.
Yeah, absolutely. So, listen, I appreciate you taking the time. I'm sure it's not going to be the last time we'll bring you here. Any people's point of some, we'll reach out once in a while and get you to talk about other things. And if you know of any of your crazy people that participating in our ecosystem that you think should be worth being here, let me know. I'll invite them to talk about it. And we'll send you the link for the YouTube channels with all those videos. So
great.
I appreciate it.
Thank you very much.
Stay warm.
Keep doing this. I will.